So, moving on to corporation tax, since 2017 we've had a flat 19% of corporation tax, which is the lowest rate of corporation tax since it was introduced back in 1965. The rate peaked at 52%, would you believe, in 1982, but it's clear that the 19% that we've been accustomed to was extremely low and set at that level to make Britain a place to do business and for the economy to thrive and prosper in attracting multinational investment. If you compare our rate compared to our G7 counterparts, rate, even from the 1st of April when it rises to 25%, still remains competitive. Where an accounting period spans the 1st of April 2023, then 2 notional corporation tax accounting periods are created and profits are apportioned on a time basis in determining the overall corporation tax rate for that period and the exposure for the whole of that period of account. But these changes will not necessarily affect every company. It will depend upon the level of profits. What this really means, though, is that there is a convoluted way to determine the precise rate of corporation tax payable at certain levels of profits. It means, in simple terms, there are 3 rates of corporation tax. 19% for profits up to £50,000, a marginal 26.5% for profits between £50,000 and £250,000, and 25% for profits for £250,000 and upwards. So for the first time in 5 or 6 years, it will be important to consider company by company and accounting period by accounting period where the taxable profitability will fall and what measures can be taken to mitigate this quite, as far as possible. That sounds relatively straightforward. Of course, nothing ever is. I need to talk to you about associated companies. These rules are reintroduced from 1st of April 2023, and they look at a company that has control over another, or where both companies are under the common control of the same person or group of persons. The reason that we need to establish associated companies is that the levels at which corporation tax rates change is split by the number of companies under common control. So if there are 2 companies associated, the 50,000 profits chargeable at 19% is split so that each company has 25,000 taxed at 19%, and similarly the main rate would be split to 125,000 for each company, determining the rate change to 25%. So that's all well and good if your company is profitable and have a steady similar levels of profits. But if they do not, you end up in a position whereby one company may pay 19%, another company may pay 26.5%. This is bad news. There may be opportunities for management charges or something similar so that you can try to flatten your profits between the entities, but such management charges would of course need to be commercially justifiable. It does also call into question the timing of capital expenditure, creating capital allowances to maximise tax relief, or even further planning such as disapplying rules of the exemption for SMEs to be outside the scope of transfer pricing. Just some examples on associated companies here. The first slide shows an individual owning 100% of 2 separate companies. Until 1st of April 2023, they were not associated. But from the 1st of April, they will be because they're controlled by the same person. There are further ramifications where companies are owned by family members, even if they individually own 100% of each of those companies. So in this example here, if they're not family members, this example, they actually operate from the same premises, and one provides bar services and one provides restaurants and food, and they operate from the same premises. Before April, they're not associated, even if they're family members, but from April they will be, because they're family members with a substantial commercial interdependence between their companies. Where you have groups of individuals, related or otherwise, that control one or more company, they will be associated. So in this example, separate trades, not dependent upon each other, but commonly owned, will mean they are associated. But until now, there will have been no tax advantage. The number of associated company affects entitlements to many reliefs that are shown on the slides. You really do need to take some advice, but one thing is a really, really big factor, and that is from April they will be included in any calculations to determine whether a company has to pay its tax in quarterly instalments. So tax by a company is normally paid 9 months after the end of the accounting period in which it relates, but where it is large or very large, it pays corporation tax in quarterly instalments throughout the accounting period in question rather than 9 months after the end of it. So a very large company, defined by profits of £20 million or more, pays tax at months 3, 6, 9 and 12 of the accounting period. A large company pays tax at 6, 9 and 12 months and 3 months after the end of the accounting period, and that's after the second consecutive year that it becomes large. So these 20 million and 1.5 million limits until now have only been split between 51% subsidiary companies of the same group, whereas from 1st of April, the number of associated companies is used to divide those limits. So there'll be far more companies paying tax by instalments, I'm afraid. I want to mention transfer pricing very briefly. This broadly affects transactions between parties, particularly those between different countries and tax regimes worldwide. So for accounting periods starting on or after 1st of April 2023, there was a requirement for all companies that do not fall within the SME exemption to maintain transfer pricing documentation using HMRC's template. HMRC have not yet provided that template, even though it goes live from the 1st of April. But please make sure you take advice. So, remuneration planning. For many years, with lower corporation tax and lower income tax rates on dividends, it's been widely known that the most tax-effective way to extract profits from your company will be by dividend. But we have seen changes. There was a 1.25% income tax increase in dividend taxation last year. When the 1.25 national insurance levy was abolished, the 1.25% dividend tax levy remained, and also, of course, corporation tax rates are now changing. So now is the time to see if dividends are still appropriate. I can tell you that across the board, whether you're a basic, a higher rate, an additional tax rate payer, or even a marginal 60% taxpayer, that everything has changed. There are some situations, again depending upon the rate of corporation tax, where a salary is more effective than a dividend. There are 4 slides. The first one here is for a basic rate taxpayer that confirms what we know to date, and that is that dividend extraction is still the best way to do it. If you're a higher rate taxpayer paying 40%, things have changed, depending on whether your company pays tax at 19%, is in the marginal rate of 26.5% or 25% main rate. You will now see that the scales are turning. Extrapolate that further to an additional tax rate payer for 45%, and it changes once more. And if you're a marginal 60% tax rate payer, then you can see there are further complications. You really do need to take advice, and these rules go live from the 1st of April. The final subject I need to cover are capital allowances. So firstly, the super deduction, whereby relief can be obtained for 130% of plant and machinery additions, comes to an end at 31st of March 2023. And remember, this is available to companies only. For many years, we've had an annual investment allowance, which enables 100% relief to be obtained on other capital expenditure. And for the last couple of years, this has been set at £1 million. This level remains beyond April and has meant that more than 99% of companies have had full tax relief on their capital spend in the year in which they have incurred the expenditure. But we have some changes also. We have something new called a full expensing allowance. There is a new first-year allowance described as full expensing of capital expenditure. Again, this is only available to companies and available through to 2026. It effectively means that this new first-year allowance with no limit of expenditure, where plant and machinery can effectively be expensed, it means you're going to get 100% tax relief on a limitless level of plant and machinery spend. This does only apply to new assets and not those acquired second-hand, though. For other items aside plant and machinery, so special rate assets such as integral assets, a first-year allowance of 50% is available, again unlimited, and the remaining 50% is then added to that particular capital allowance pool for allowances to be claimed at 6% per annum going forward. I've tried to set these new rules out in a slide for you, but there are a few strange, quirky things about these changes. The first is that the annual investment allowance is still available, but essentially will only likely to be used for the purchase of second-hand plant and machinery. It can now not be used for integral assets, for which the relief will be, going forward, much reduced from the current levels. The second is that when you sell an asset which has the new fully expensing first-year allowance claimed on it, then a balancing charge will arise. It is a separate calculation and does not go through normal capital allowance pooling that you would expect. For integral assets, it is a step more complex, with 50% creating a balance charge and 50% of the proceeds going to the special rate pool. But if you are a large company with capital expend in excess of £1 million, though, these rules are just fantastic. You'll get full tax relief on all of your plant and machinery spend in the year in which you require it, and that's limitless. But for 99% of the companies, there will be little or no effect, just changes in the rules. But again, take advice, as there are some strange elements of these new rules, particularly where your accounting period straddles the 1st of April 2023.